Hello, I'm Mark and welcome to Little Known Stocks, the show where I try to prove that being boring and doing your research, in this case unfortunately, will stop you losing more money than you've already lost. So yesterday was Evofem's earnings call and it was not a great one from my perspective. I'll talk you through the reasons why. I've decided to sell part of my position, so at the moment I've sold half of my position and I'm considering whether I want to sell the rest and looking around elsewhere in the market. It's important to note that I laid out some criteria in a previous video that I did on Evofem, which I will link down below. In that video, I laid out some criteria as to what I wanted to see in this earnings report. So I am selling out now, and we are at almost an all-time low for this stock, but I'm not selling out because I'm panicking at the bottom. I'm selling out because I no longer believe in the company's fundamentals, particularly their balance sheet, which I'll go through in a moment. There is a difference between panic selling and understanding the position that the company is in and making an informed decision. So Evofem's Q1 results. Now it's worth saying that they were extremely positive on the call. They were really trying to make it sound like a big win, which many people took it as. That the share price rose significantly post hours, about 22% up at one point, and then opening in the market today it was around 8 to 11% up before quickly dipping back down. So people actually took this as positive news. The main thing they focused on was this March versus Feb number. So 83% total prescription growth. They did have their direct-to-consumer launch in February, but it was on the 14th of February. So March was their first full month with direct-to-consumer. But they also report that there's a 78% increase in healthcare providers prescribing Phexxi. So that's really significant as well. So the growth isn't just coming from their online platform. In fact, the online platform is slightly underwhelming given how far they've built it up. What's worth noting is this 1.1 million compared to 0.2 million in Q4. So that's really very strong growth. But 1.1 million in sales for an entire quarter when you've been building up, you've been advertising massively, you've been out there talking to doctors, talking to pharmacists, launching your direct-to-consumer campaign with advertising all over the place, is really not strong and a very concerning number from my perspective. The selling and marketing costs for the quarter were $30 million to generate 1 million in sales. That's a very poor return. Selling and marketing costs were 30.5 million, reflecting the commercialization of Phexxi, including media, advertising and public relations expenses and sales force costs. So they've got a significant sales force cost. If we look at their last full year filing, so this isn't comparable to the quarterly filing that we've just had, it was 56 million. So they're going to be significantly up on that this year. And the rate of growth just isn't really enough to justify that expense. I'd expect to see it, 200-300%, particularly as it was their first quarter last quarter. So really not very impressed there at all, both from a sales and a gross to net perspective, as they were talking about bringing their gross to net down. So their loss for operations at 45 million is just not sustainable for a company of this size. It's really not sustainable. And I can take the 7 million research and development costs. That's good money that's going to generate them revenue in the future. But this is just far too lavish for a company of this size, and they are being reckless. Now, if I think about traditional selling and marketing in a company, I think about big companies going out business to business, having business managers, account managers, that sort of structure. And as you grow, you become more efficient through those sales. But selling and marketing for a company like Evofem is really one-to-one. There's not necessarily a fixed cost. I think there's a lot of variable costs with that. So if I think about their online platform, for example, which you'd normally expect to be very profit accretive, they have to employ a doctor to do every prescription on that. So every prescription costs them a significant amount of money to do. So as they grow, I don't necessarily see their sales and marketing costs shrink. Similarly, if you're going out and you're talking to pharmacies and you're talking to doctors and you're trying to drum up sales that way, yes, there will be some big pharma brands and there'll be some chains that you can get big sales into, which would be, immediate growth, and you'll have account managers for those. But it's a very diversified industry. There's lots of small clusters here and there. So again, you might have some fixed costs that you can build up against, but you are going to have to pay a lot for a lot of additional sales. So I really think this number is going to grow over time. I don't think it's going to shrink at all. There is the media budget, which they've obviously pushed a lot recently, and we don't know how much that accounts for, but this number's been significant for a while now before they started the media. So their sales team is making up a significant proportion of that number. Not only that, but we know how this company deal with their deficit. They issue more shares. So we can see on their balance sheet again, they've issued 17 million more shares versus the original 81 million in the last quarter. That diluted my shares and everyone else's shares by 23%. If you were in the stock at the time, you know that this dip here was the CEO selling. This dip here was the sale of additional shares at the price of $1.75, when prior to that we were hovering around the mid $2. So there's a really significant issue that they're offering new shares to pay for it, diluting the existing shares, but they also have to offer them at lower than the existing share price, meaning that the price then drops. So I think that's going to happen at least a couple more times over the next year, and I expect to see massive share dilution and a continuing drop of the share price over time as they have to raise this new capital. But it is worth noting that 83% growth month over month is really impressive. It is the month that they launched their new platform, and I would have expected if April had been a really good result as well, they would have given us an indication as to April's figures, which is what I was looking for. When the last earnings, they actually updated the months afterwards as well, because they were pleased with the results. So because they haven't done that this time, I think they're trying to hide those results. And certainly the 83% is the standout figure here. I expect maybe even a decline in April and May, but we'll have to see. The second major reason why I'm really skeptical is this chart here. So those of you who watched my previous video will have seen this chart, and you will have seen this exact chart. So this basically is their investor presentation. It shows the new prescriptions month on month and the refills month on month. And in my previous video I really wanted to see this refills number grow to have confidence that people were coming back with 6, 7, 8 months on the market. They should be getting a good idea of what the refill rate is going to be. Now on the earnings call they were asked by Annabelle Samimi, can you tell what the refill rates are overall? And they basically dodged the question. They mentioned that they are being cautious, they want to give it time, they want to see the impact of direct to consumer, and they referenced the survey that I referenced before that said on exit studies they expect people to come back in the high 80s at low 90%, but they gave no data whatsoever. They brushed it aside, which for me is really discouraging. And if we look at previous data, so they've only done January, February here, but you know me, I like to do my own numbers. So using their new trial and refill rates that they've shared in the past, we can see that first off we started with, in September, 4 refills. 4 really horny women refilling in the same month they got their first prescription. Then good steady increase, and January, February we kind of slowed down dramatically as the growth kind of slowed down. So 2% refill growth in January, 24% in February. Now the report, as we saw, mentioned 83% growth in total prescriptions. That is with their direct to consumer. So that's 83% increase March versus February with their direct to consumer included. They haven't reported that number here at all. They've left it off their investor presentation. And for me, that's a company that's trying to hide some results. And I don't like that at all. The other thing to say is that I think they're making less money on the initial prescription, which obviously means you want to move into recurring revenue and refills as quickly as possible. So if that's really not happening, then I think they'll be less profitable even in the short term, let alone the long term when you're not getting regular refills. So they eligible patients, and this is through a co-pay scheme, so it's based on insurance, may receive 0% co-pay for their first fill, pay as little as $30 on future prescriptions. And what I think Phexxi are doing, because I haven't seen anything like this for other prescriptions, I think they're paying the $30 themselves, meaning that's an upfront cost for all the new prescriptions. So the higher the new prescription to refill rate is, the less profitable they're going to be, and it's hurting their bottom line significantly. It's also worth clarifying that I do still think this company has a good product. I just think their execution is quite poor at the moment, and maybe there's not the demand for that product at the moment. It could be a very, very slow grower, and I think there's going to be a significant cut to the share price over the next several months and years before we really see them return to profitability. I could be massively wrong. If this growth continues, great, and I may even buy in further down the road if I start to see the expenses come down and the growth increase month on month like it has from February to March. I may buy in again, but honestly I expect this share to go down to $1, 90 cents, 80 cents before I'll buy in again. I think there's a long way to go. If they turn it around, if they get through this period and then they launch EvoGuard, I'll be looking very, very closely at that period and see what the share price is then. I think, as I said before, EvoGuard is a game changer. It's a completely new product for the market, so that will really take off. I think they just need to get there first and not go to zero. But that's all I've got time for today. I must admit I am really, really conflicted on this stock. I was really hoping for some better news and actually more transparency in their figures, which is one of the reasons why I'm so disappointed in this earnings call. But you have to admit when you're wrong and sometimes review your position and decide what action to take. So if I'm missing anything, I would love to hear in the comments below. I've been really impressed with some of the comments that I've received, and they've helped me to form new opinions, which is really great. I'd love to hear it in particular on this stock because it is one that I'm so conflicted in. So with that, please like and subscribe if you like the video, and I wish you all a very good day and weekend.